Hi, my name is Ben Bingham, and I'm here with Dan Martell, the CIO of 3Sisters Sustainable Management, to talk about the market. We are impact investors, and we believe that the stock market should be part of the strategy for impact investing. The companies that are beneficial to the planet and to society should be rewarded by stock prices that reflect the value that we have in society. And I think that this is a tendency that's happening. People don't really want to own companies that are not doing the right thing. So besides that, there's the whole sophisticated way of dealing with a portfolio in the market. And we have one of the best in the country here, and I wanted to give him a chance to talk about how he's managing in a difficult market. So, Dan, we just saw two of the worst days in the market for a long time here in February of 2020. Can you talk about how you did and how you prepared for this and what you see going from here?
Sure. I think that the key to managing a portfolio is that you have a plan in mind when you hit days like the last 2 days, that you have been incorporating management techniques for a period of time so that when stuff begins to happen like we've seen the last 2 days, you're not scrambling to try and figure out what to do. You already have embedded in the portfolio aspects that give you some protection from the downside risk. No one foresaw coronavirus happening. The market was rocking along at exceptionally good levels. We were running at substantially high prices through January and all of February. And then this unexpected event, whether it's a black swan, I don't know, but an event came along which really changed everything. And you go and look in places like China, and what you see is the effect of the coronavirus was that car sales went down by 92%. 70,000 movie theaters closed. And so everyone is sort of super concerned that if that were to move out of China into other countries, which it's begun to do a little bit, hasn't really hit the United States yet, you start getting some really devastating effects for the short term on the economic ingredients of a market. So what we have done for a while, we really started last summer. We were up substantially. We wanted to try and protect the being up 20% return we had back in June. And so we started building in a lot of circuit breakers, a lot of building in techniques that would give us some embedded positions that would help in case we had a downturn. In October, the market really turned bullish, really almost a second bull market. And we were able to benefit by getting in line with that bull market and riding it. The whole time, we still had these positions embedded in the portfolio that were like an insurance policy. They were costing us some return, but we thought it was important to have them in there. Secondly, we upgraded and continued to push our use of more sophisticated options techniques, which really did insulate the portfolio from losses. And so when things began to fall apart on Monday, the result was the first wave, we recovered pretty well because we had a lot of positions embedded that were going to be positive when the market broke, and they were going to be profitable. We had also done some, without getting too much in the weeds, some options spread strategies against the portfolio that gave us some moderate protection. And the third thing is that we started doing a lot more what we call stock replacement, which means that we end up owning an option which has a definable downside risk as opposed to a stock which has an unlimited downside risk. So when stocks like Microsoft started to really tumble, the options we had against Microsoft went down at a much slower rate. And that's helped us to not avoid a very difficult 2 days, but it allowed us to really experience a much better outcome. And so, as I was saying, I think the key is not trying to figure out what to do yesterday morning when you walk in and see the market sharply lower, but to already have planned for these things, even though we had no clue that coronavirus was going to be coming. We were prepared to use our techniques to minimize some of the downside effect.
Thank you, Dan. When I was training as a farmer and farmed for many years, hedging around a field was to reduce the winds of volatility. And it's the same idea, really. It's, hedging has a kind of a bad name, or people think of, financial engineering and doing tricky things in a black box that you don't really know what's going on. And sometimes it does extremely well, and people have outrageous returns. That approach to hedging is not what we've been doing in this portfolio. It's really, as you could hear, a way of protecting the reducing the volatility, and just a way, when the wind hits a hedge, it goes up and over the field and doesn't blow the crops as strongly. It also creates a microclimate. So there's some really neat parallels in ecosystems. So thinking about going forward, Dan, what do you see in the market ahead? How do you feel we're positioned for that, and what are you going to do to protect going forward? Anything different?
Well, I think if you look at some of the long-term forecasted numbers, historically, within 6 to 9 months, 93% of the time the market recovers on these kind of downward moves. And that's sometimes really a harder recovery, because the downside move comes from some change in the business climate. This is being driven by a very unusual coronavirus that's basically handicapping many countries. And the other fact is that they say that 63% of the time, within 3 months, you recover on the market. So the numbers are on our side, and I think the expectation is that the coronavirus will have its day. And I doubt that we've seen the worst yet, but that we're talking about a 4 to 6 week problem, that as we get into the warmer months and as we get into any virus kind of running its course, I think we'll find that the market absorbs the effect. It'll continue to show up in some of the sectors, which will be hurt for a little bit longer period of time, but the market as a whole should stabilize and recover for the balance of the year. How far it recovers, I don't think anyone really understands that, because it's such a complex process. But I would think that even now we're basically break even for the year, and I would think that there still could be a strong year coming up. And also, we still have in place a lot of these circuit breaker type positions that help the market, have helped us outperform. And really, actually, we're continuing to increase the usage of those in case the market continues to go down much further.
Thank you, Dan. We'll have another conversation soon. So I appreciate the insights that you've shared today. Thanks a lot.
Anytime.